In 1717, the Mississippi Company went out to America to sell the lower Mississippi Valley. During this time, they created New Orleans. To pay for all this, the Mississippi Company sold shares in the Paris Stock Exchange. The Mississippi Company bragged about great riches in Mississippi, which convinced businessmen, aristocrats, and the affluent urban to buy into the company. This caused the stock prices to rise tremendously, as the demand was high. Initially, each share was at 500 livres each, but by August 1st, 1719, shares were trading at 2,700 livres. By the end of August, they were worth 4,200 livres. And on the 4th of September, just a few days onwards, they reached the price of 5,000 livres per share. On the 2nd of December, the price of a single Mississippi Company share was over 10,000 livres. Parisians were euphoric. Some had doubled their money, others had tripled it. Some had made 10 times as much in just a couple of months. French citizens, unaware of how the stock market worked, sold everything they owned just to get more shares of the stock they knew would go up. They took huge loans to buy Mississippi shares. Everyone thought that they had discovered a gold mine, an easy, infinite, and sustainable way to make money quickly. They were unaware of the mechanics behind the stock market and were swept up in the excitement. Just a few months after this euphoria, panic swept into the public. Businessmen and shareholders had realized that the share prices were absolutely ridiculous and would eventually collapse. They sold incredibly large quantities of shares, rationally thinking that they had made enough of a profit and didn't want to take the risk of the market crashing. As there was suddenly more shares available in the market from those who had just sold them, the price fell. As supply went up, demand went down. When other quick-thinking speculators saw the price falling, they immediately sold all of their shares, causing it to fall even more. This set off a chain reaction. More and more businessmen and large holders sold their shares. The Central Bank of France panicked, realizing that its citizens were about to go bankrupt, and bought enormous quantities of shares, trying desperately to raise the price. Eventually, the Central Bank of France ran out of money. All of its liquid assets were invested in steadily declining stocks. The bank was then authorized to print more money in order to buy more shares. This put the entire French financial system directly inside of the bubble. The price quickly fell to 1,000 livres a share and then crashed completely. Now the Central Bank of France was bankrupt, as were many Parisians, many of whom committed suicide. It was not the speculators, bankers, or economists that suffered from this. It was the general public, who were swept into a false sense of security and did not have the time or know-how to sell their shares soon enough. This caused a lot of the French public to lose all faith in the French financial system. This was one of the most spectacular examples of a financial bubble popping, and one that is simple enough to explain to others with relative ease. This explanation was inspired by Yuval Noah Harari's book, Sapiens, which I highly suggest you check out.